Hello, hello again. Paige Panzarello here, the Cashflow Chick. And I wanted to talk a little bit today. Last time we talked about my buying first position non-performing notes at a very big discount based on the current market value of the securing collateral. And then I alluded to the fact that note investing on the whole checks a lot of boxes and can be very fun and exciting, not only for you as an investor, but also for your potential JV partners and investors, not to mention our borrowers. So I wanted to kind of touch on that a little bit today and discuss kind of what I mean by it checks all the boxes, and then get into how it can be very lucrative for you and for your investors, and also how it creates a win situation for your borrower as well. Okay. All right. So let's start off with a couple of the things. Number one, I am very risk averse. And so note investing, because we have 23 different exit strategies, that allows me to be able to pivot given just about any situation and be able to mitigate my risk, which for me is really, really important. Not all different forms of real estate or real estate investing can boast that it's got 23 different exit strategies. Now, typically, understand, we don't use all 23 exit strategies every single day. However, we do use 4 of them on a very, very regular basis, and that I will discuss with you in another video. But in this, I just wanted to mention that that we do have 23 different exit strategies, and so that allows for a lot of mitigation of risk. So your risk goes down exponentially. Nothing is ever without risk, including getting out of bed in the morning, right? But when you've got that many exit strategies, it really allows for mitigation of risk. You as a note investor also get to control the purchase price and the exit price. And what I mean by that is, if the numbers do not work for you, now remember, I said I buy at a very big discount based off of the current market value of the securing collateral, not on how much money is owed, okay? Based on the current market value of the securing collateral, and I discount it from there. So let's call it a 50% discount for easy math. When I discount the note purchase price by that much, I am in control. It allows for a very large position of equity, a cushion of equity, and that also is going to allow me to work with my borrower. I'll explain that in a little bit, okay? But you control the purchase and the exit and the sale price. And you can work with your borrower to get them to reperform, and we'll talk about that in just a minute as well. Another box that note investing checks for me is that I can control the length or the term of my investment. So if I'm a short-term investor, meaning I want to create some profit in the short term, and when I mean short term, I mean anywhere between 12 and, let's call it 6 and 16 months, because some of the exit strategies can be as short as 6 months. Some might take as long as 16 months. We'll talk about that later as well in another video when we discuss the different exit strategies. But I can control, as the note investor, I can control whether I want this to be a short-term investment for me or a long-term. So if you're the type of investor that you are looking more for monthly cash flow, and you're in it for the long haul, this might be the avenue for you. Again, and then you can kind of create a combination. In other words, if you feel as though you wanted to go into this as a long-term investment, and then 3 years down the line decide, you know what, I think I want to sell this note and recapture my capital so I can invest in other things or more notes, then that is the availability that the availability. That is what is available to you as a note investor. So again, you can create and dictate the length of time for your investment and your invested dollars. Now, this is the coolest thing about notes and note investing. Besides helping people, of course, for me, that's the coolest thing. This is the second coolest thing, I should say. You get to create not only chunks of cash, but streams of monthly cash flow in the same investment vehicle. Notes is perfectly positioned so you can create chunks of cash and also streams of monthly cash flow. I have also been very fortunate in my own portfolio of not only creating a chunk and a chunk of cash and a stream of monthly cash flow, but also making money not once but twice on the same asset. So we'll discuss that when we get into the different exit strategies, how I did that. But it's very fluid. It allows for you to create chunks of cash and streams of monthly cash flow in the same investment vehicle. Now, you also want to start with the end in mind. So for me as a note investor, because again, when you are the bank, when you become the bank, and that's exactly what you do when you become a note investor and when you buy a note, okay, you become somebody's bank. And when you become the bank, you get to dictate the terms. You get to dictate how the process is going to go. Now, obviously, there is an unknown factor, and that is you don't know what the borrower wants to do. However, I will say that in one of our stages of due diligence, and there are several different stages of due diligence, we'll talk about that in later videos. But in our due diligence, we actually have the opportunity to review some of the service or collection notes, and that will give you insight as to what the borrower may or may not want to do with their note, okay? So for me, starting with the end in mind means that I get to hopefully work with my borrower and get them to reperform. We're going to talk about that in a minute because I want to tell you about some of the benefits and how it's very lucrative for you to work with your borrower, not only for you, but it creates a win for them as well, okay? But I go into every single note knowing that I am hoping to help that borrower stay in their home, okay? You also can look at specific notes if you want the home. In other words, if you're a fix and flipper and you want a house to fix and flip, hopefully you're going to target notes that are already vacant, meaning the borrower has already left. Trust me when I tell you it's not fun kicking families out of their homes, okay? So if you're a fix and flipper and you want a house to rehab, this is a great vehicle for you. However, I'm hoping that you'll target houses that have already been vacated by the borrower. So you're not kicking somebody out of that house, okay? But again, you're starting with the end in mind. You know what direction you want to go in, and you can control that, okay? The other thing that is fantastic for me as a note investor, one of the other boxes, is that this is not location specific, meaning I literally can be anywhere in the world and do this business as long as I have a cell phone and an internet connection, okay? So a lot of times, as you know, in fixing and flipping, when you're fixing and flipping a house, you have to be on site. You have to manage that contractor and make sure that he's doing what he says he's going to do, or she, right? So oftentimes fix and flippers are really, they don't go out of state. I can invest nationwide because it's not location specific. I rely heavily on the internet and also local boots on the ground. We'll talk about that in a different video, how to establish relationships with people so you're not flying off to see these properties. I don't get on a plane and go and visit the properties. I do not do that. I do everything by phone and by internet and by email. And I can literally do this business sitting on a beach somewhere and enjoying myself without having to worry about getting on a plane and having to go visit a property or manage a contractor. So it's not location specific, which I think is awesome. Also, this is very easy to put systems in place and then scale. So this type of business, it's rinse and repeat. right? There's a process you go through. There's steps that you take. Again, we'll talk about that in due diligence a little bit later in a different video. But there's a system that you put in place, and then it's just rinse and repeat, okay? And if the deal does not conform to your guidelines and what you determine is good for you, then you don't do the deal. It's really that simple. And it's very scalable. There are many different ways that you can scale your business. And the other thing that for me that it checks a box is that this business is very front end loaded in terms of your time. Time is our most valuable asset, everybody. It is our most valuable asset. And so I'm very protective of my time. I don't waste it chasing deals that don't conform to my guidelines, okay? You put your guidelines in place and then you stick to them, okay? But time in the note space, the heaviest part is the front end, meaning when you get a tape, it's called a tape. It's basically just an Excel spreadsheet that the banks send to you. And by the way, those are free. We'll talk about that in a little bit in the next video. But when you get a tape, you literally spend the bulk of your time evaluating which notes you want to possibly purchase and then making offers on them. And then once you have an accepted offer, now you're going to do some due diligence, okay? Once you go through that process, that's where you're going to spend the bulk of your time. Once that is done and you actually buy the note, you actually hand off the day-to-day operations to your team, okay? And we'll talk about who your team members are in later videos. But you literally hand it off to a third party who is part of your external team, and they handle the heavy lifting for the day-to-day. So your time is spent doing things like spending it with your family, right? Or if you work full-time, you don't have to worry about spending all weekend long on this other side business, right? You're able to spend time doing the things that you want and need to do as opposed to what you have to do in order to go through this real estate investing scenario, okay? So again, notes, your time, the bulk of your time is spent in the beginning, and then you hand it off to your third-party team and let them do the day-to-day, and then you just manage the managers. So you can do this business anywhere in the world. Your time is not spent doing the day-to-day grind. It checks a lot of boxes. There are many other boxes that it checks for me, but those are some of the main points. Now, let's talk briefly, because I promised we were going to talk briefly about how it's good for the borrower and how it can be lucrative for you. Now, remember when I said that the notes that I buy are based at a discounted rate of the current market value of the securing collateral. That's the house. So let's say the house is worth $80,000, but let's say our borrower bought the house at the peak of the market. So they actually have an unpaid principal balance of $100,000. Okay, now also remember I told you that I buy non-performing notes. That means that the borrower has stopped paying. So there's probably some arrearage, maybe some back taxes that the bank has paid on behalf of the borrower. We'll talk about those things in a different video as well. But let's just say that the total legal collectible balance, not principal balance, the legal collectible balance is $120,000. Okay. Now, again, the house is only worth 80. The borrower owes 120. They're $40,000 underwater. I buy my notes based on the discounted rate of the $80,000 because that's what the house is worth, right? $80,000. And then I discount it from there. So let's call it 50%. Let's say I buy this note at a 50% rate based off of the current market value of the securing collateral. So based off of $80,000. So I buy the note. I'm owed 120, but I buy the note for $40,000. Okay. Now there's some workout costs that are involved in note investing. Much like fixing and flipping houses, we're fixing and flipping paper or debt. Okay. So there's some workout costs that you have to put in and account for. Generally, they're anywhere between $5,000 and $8,500. Okay. Per 12 months. So if you're anticipating a 12-month turn, then you're going to anticipate, depending upon judicial versus non-judicial foreclosure states. We'll talk about that in a later video. But you're going to figure out about, anywhere between $5,000 and $8,500. So for this example, let's just call it $5,000. So I'm into this note for $45,000. The house is worth $80,000, which builds an equity cushion there of about $35,000. But the borrower owes $120,000. Okay, so how is this lucrative, Paige? It seems like there's a lot of numbers you're throwing around, right? If your borrower wants to stay, which is my goal, if your borrower wants to stay and get back on track, we call that RePerforming, then because we've built in such a big equity cushion, we actually are in a position where we can work with that borrower to get them back on track by maybe forgiving some debt, right? So we don't have to, we know that anything over the $80,000 that the house is worth, anything that we can get paid over that $80,000 is kind of the cherry on top of the sundae, right? It's the gravy on the mashed potatoes. We don't expect that we're going to see it, but we hope we're going to see it. So we might be able to work with that borrower and incentivize them by forgiving some of that debt that they owe. They owe us 120. A borrower is going to be very motivated to agree to a loan modification with you for maybe even $100,000, even though the house is only worth 80. You're willing to forgive $20,000 worth of debt if they start paying you on time every time. You can create a chunk of cash by requiring a small deposit. Okay, so there's so many different things that we can do and get creative with our borrowers now, and help and create a win-win situation. So if you are able to get a borrower to reperform, let's say you forgive $20,000 worth of debt, you're into this note for $45,000. They agree to a loan modification at a new unpaid principal balance of $100,000. That is now a $55,000 potential profit that you are going to see. Do you see how lucrative note investing can be? It also creates the win for the borrower. They get to stay in their home. Now, if you have a JV partner, obviously you're probably going to have to maybe split that profit between the two of you. But at the end of the day, there's a lot of potential for you to create chunks of cash and streams of monthly cash flow in the same investment vehicle and create win-win-win situation all the way around. Now, let's take that same scenario as a fix and flipper or a buy and hold person. Let's say you just want rentals, but you don't want to pay face value for or current market value for that rental. Let's say you focus on buying notes on homes that have already been vacated by the borrower. Okay, so that same scenario, the house is worth 80, you're owed 120. You buy that note at $40,000. You go through the process of either a short sale or a foreclosure. Again, we'll talk about that in exit strategies when we talk about exit strategies. But let's say you take possession of that property for $45,000, but the house is worth 80. Now, you can fix and flip it yourself. And when I say the house is worth 80, I mean the current market value as it sits, not after repair value. So if you're a fix and flipper, you know that you're focusing on after repair value, after you put money into it through construction, what is it going to be worth after you fix it? So let's think about that. Let's say your after repair value on the property is $180,000. right? And you might have to put 50 into it. So now you're into this note for 45,000 for the note, 50,000 for the repairs. So that's $95,000, but you have a potential ARV of 180, right? And you've eliminated the competition because you don't have to scramble for deals. And we're going to talk about deals in the next video. But imagine the profit potential that you've got by going the backdoor route. That's what I call it, the backdoor route of note investing. You can create your chunks of cash and your streams of monthly cash flow, and you can create win-win situations not only for you, but also for your borrower. So I hope you've enjoyed that. There's so many other things we're going to talk about. Stay tuned. I'll see you next time. Bye.